The Tax Cuts and Jobs Act, TCJA, passed in 2017, was one of the most extensive pieces of tax legislation to be passed in the last 30 years, touching many aspects of individual, corporate, and estate tax. However, most of TCJA's provisions are set to sunset at the end of 2025, an event that would have at least as much impact as TCJA's initial passage. Let's start to take a look at how it might affect you and if you should take any planning action today. Hi, I'm Hunter Brockway, founder of Boca Retirement Strategies, here to guide you to a successful, stress-free retirement while spending more and avoiding being killed in taxes. The Tax Cuts and Jobs Act modified the tax code in a wide variety of ways, from the standard deductions on tax returns to marginal income brackets to qualified business income deductions. With it being an election year and the TCJA set to sunset in 2025, there's no real way of knowing whether it will be extended or will sunset as designed. Taking a look at marginal income brackets, it's not certain what the exact brackets will be, but we can take a look at the numbers prior to TCJA and incorporate inflationary assumptions. The 7 brackets of marginal rates will shift up about 1 to 4% each, except a couple. The income thresholds of which those brackets jump stay relatively similar unless you reach higher levels of income in the 24%, soon to be 28% bracket. An example of a significant jump is a married couple earning between $291,000 and $384,000 of income in 2024 dollars. Their tax bracket would rise from 24% to 33% between the combination of percentage change and income threshold change. However, there are income ranges, particularly for single filers, where the taxpayer will be in a lower tax bracket after TCJA sunset, which means that accelerating income, such as via a Roth conversion to take advantage of today's lower tax rates, could, for many people whose tax rates will actually be lower after TCJA sunsets, result in paying a higher tax rate on that income today. In addition to marginal rate changes, taxpayers will see their standard deduction decrease. The standard deduction is a dollar value the government allows every person to deduct on their tax return. This applies to most people. For example, someone working a W-2 job whose only claim for a tax deduction that year is a $100 check they made to charity. That check won't do anything on your tax return because currently the $14,600 for single filers and $29,200 for married filers standard deduction is greater in value than that check. Of course, tax breaks shouldn't be the only reason to give to charity. Now, those $14,600 and $29,200 standard deductions are set to drop to $7,850 and $15,750, effectively meaning you'll have a larger tax bill one way or another, whether that means less of a tax refund you get or a bill to pay at the end of the year. For those who may fall into the alternative minimum tax category, like those exercising work stock options, the threshold before hitting AMT will be decreased. For those who have more deductions than the standard deduction, 100% of state and local tax payments will be able to be deducted on Schedule A rather than being limited to the $10,000 they are today. Miscellaneous deductions above 2% of the taxpayer's adjusted gross income, AGI, including unreimbursed employee expenses and investment management expenses, including investment advisory fees deducted from clients' taxable accounts, will also be allowed after being suspended by TCJA. Additionally, TCJA's expiration will raise the cap on home mortgage interest deductibility. With these changes, likely more people will be looking to itemize deductions rather than take the standard deductions, so keep that in mind when considering to save those receipts. Prior to the TCJA, taxpayers who took personal exemptions or itemized deductions had a threshold to worry about. As a reminder, the personal exemption phase-out, PEP, reduces personal exemptions by 2% for every $2,500 of AGI above that threshold. By the math of the phase-out then, all personal exemptions are completely phased out after reaching $122,501 in income over the threshold, estimated to be between $389,000 and $511,000 for married filing jointly, and $329,000 and $446,000 for single. That means fewer personal exemptions. Many businesses benefited from the TCJA via the QBI deductions. The qualified business income deduction, which provided certain businesses to deduct a portion of their income, will be eliminated. Larger families could actually see a benefit after TCJA sunsets due to the renewed eligibility for personal exemptions of income per dependent. The last big factor for today's consideration is the estate and gift tax exemption. Currently at over $13 million, it is estimated to drop to about $6.8 million. Ultimately, it may not be worth stressing over predicting what exactly U.S. tax law will be at the beginning of 2026, since the outcome hinges on both elections that will take place in late 2024 and legislative negotiations that will likely extend deep into 2025. But does the political uncertainty surrounding the TCJA sunset provisions make it impossible to do any tax planning before the situation is resolved one way or another? Again, we don't know the exact numbers yet, but it stands to reason to take into account your filing status, current income bracket, QBI or no QBI, number of deductions, to consider whether to accelerate income or delay income today. So take action. Number 1, consider if you should accelerate income or RMDs, or if you should further delay. Number 2, if you are considering selling a non-qualified asset in the future that could affect your AGI and bump you into higher brackets, evaluate that timeline. Number 3, review stock option schedules. Number 4, review your cash flow strategy should your tax rates be affected. Number 5, consider shifting or reducing your taxable estate. Number 6, subscribe to our YouTube channel. I'm Hunter Brockway, founder of Boca Retirement Strategies. If you have any financial questions, feel free to reach out at contact@bocaretirement.com. Enjoy your successful retirement, and thank you for watching. Bye. One last thing, we are also slowly setting up a retirement mastermind group I am calling Retirementality. If you don't know what a mastermind group is, it's a group of like-minded individuals getting together to help each other solve common problems. We plan to run this group in a roundtable format, so peers can help each other. We might talk about things like finance, things like healthcare, things like travel, things like local events. If you are interested in joining this group, you can send me an email at contact@bocaretirement.com. This will be a complete anti-sales group designed purely in helping you help others retire successfully.